Welcome to Pocket Risk Manager, the simple and intuitive software system for performing actuarially valid casualty loss forecasting and reserve analyses. For best viewing results, please click on the open and close brackets icon at the lower right part of the video. This will allow you to see the video in full screen, which will greatly assist for following along. Pocket Risk Manager software and technical support is free for qualified users. To learn how to obtain your copy of the software, please refer to our website. This instructional tutorial offers a summarized example for using Pocket Risk Manager to complete a loss forecast and reserve analysis. You are looking at the default setup screen, which loads when you launch the PRM icon. Entering your company name begins the data entry and selection process. Select type of coverage and type of analysis. For forecast methodology, you have a choice of 4 different methods. You can choose one or more methods simply by clicking on the appropriate box. If you want to perform a loss forecast for one or more self-insured retentions, make sure to select Yes to large loss data. If you have frequency data, please select Yes. For legal expenses or allocated loss adjustment expenses, select whether these expenses are inside or outside of the retention limit. Pocket Risk Manager will automatically ensure that these expenses are appropriately handled for your coverage provisions. Moving to the upper right area of the screen, if you have discontinued operations, you can select Yes. And Pocket Risk Manager will automatically exclude these losses from your loss forecast while preserving those same losses for your reserve analysis. Choose type of loss dollars. Choose the exposure type and your label for exposure dollars. The remaining selection entries on the right side of the screen are comprised of loss development and inflation rate data. Pocket Risk Manager allows you to use built-in loss development and inflation factors, use your own factors, or mix and match built-in and custom schedules. As an example, we look at incurred loss factors. You could choose from our built-in schedules, or you could choose manual input, in which case you would enter your own loss development factors calculated from triangle data. However, for purposes of this particular example, I'm simply going to stick with the industry schedules. Moving to the bottom right part of the screen, we enter appropriate policy year data, making sure to click on the forecast year, and we have completed the setup screen. Before moving on, however, note the context-sensitive menu at the top of the screen. At a minimum, every screen has a Help button and Next button. The Help button takes you to a detailed write-up on how to fill out a particular screen. The Next button automatically takes you to where you need to go to complete your analysis. Here, we've moved on to the input screen for summary policy data. The policy data on the left is automatically filled in. Remaining cells represent summarized loss and exposure data according to policy year. To minimize data entry, as well as reduce clutter on the screen, notice that certain areas of the screen are blacked out. These areas represent data that you told the system is not necessary for this analysis, such as discontinued operations or separating loss and expense data, given that legal expenses were selected as being inside retention limits. With this screen complete, we'll click on Next. And we'll move to the final data entry screen, which is large loss detail. Here we input detail for individual claims above a specified threshold. which you determine according to need and availability of large loss data. With this screen complete, we click on Next and begin the loss forecasting process. It takes us to the Incurred Loss Forecast Methodology screen. Here, all you need to do is focus on the ultimate loss per exposure column, which is highlighted in light blue. As you examine the figure for each year, note the general downward trend, which eventually levels off for more recent years. Management will be thrilled to learn that investment in claims management and loss control activities have produced tangible results. Here's where your judgment is needed. Examine the consistency of the highlighted ultimate loss per exposure figures, look for trends, and give added credibility to more recent policy years, though with the possible exception of the very most recent policy year, as this year is the most green. If one or more of the figures are not consistent, then you simply need to place a check in the box to remove the statistic from the forecast. In this particular example, I'm going to exclude the older years given the general downward trend. And with that, we've completed our loss forecast. We have an ultimate loss per exposure selection of 1.09, which leads to an ultimate loss forecast of $1,308,000, limited to $350,000 per occurrence retention. We can look at some graphs. Had we specified in the setup screen that we only wanted to prefer an incurred loss forecast, then the forecast would be complete. Because we elected to perform additional methods, when we click the Next button, it'll take us to the next method, which is the weighted average method. Here, I've already made the exclude versus include decisions for you. So we're just going to cycle through this, the paid loss forecast, and the case reserve forecast to get to our final result. Look at some graphs. We click on Next. It takes us to the paid loss forecast and the case reserve forecast. And finally, we see the summary forecast screen, which shows the averages results of the 4 forecast methods. And it also gives us some flexibility to exclude one or more of the methods if needed. In the process of performing the loss forecast, we already entered all of the data needed to calculate the reserve analysis, so no new data input or analysis is needed. You can view the reserve analysis by simply clicking on the menu heading. The reserve analysis screen shows remaining liability and discounted remaining liability by policy year and in total. Also note that the menu bar will allow you to easily navigate to any area of the screen in order to inspect and or revise data input or forecast decisions. So with that, our analysis is complete, but I do want to show you how easy it is to model alternative self-insured retention levels. The forecast that we performed was for a $350,000 self-insurance retention. Let's say we now want to see a $500,000 retention. For Pocket Risk Manager, this is very easy. We'll just go back to the summary data input screen. Notice the orange box specifying the excess limit for the forecast year at $350,000 per occurrence. We'll change this to $500,000 per occurrence. And our forecast is already been updated to reflect the $500,000 per occurrence forecast. However, we do need to cycle through our forecast methods just to make sure that we don't need to change any of our previous decisions. But pending, if no additional changes were needed, you would see that our loss forecast summary screen shows the updated forecast at a $500,000 per occurrence retention. This concludes our overview tutorial. Thank you for your interest in Pocket Risk Manager.